Welcome everybody. Today we are going behind the scenes in regards to our YouTube Shorts. If you're new to the channel or you are familiar with our channel, we produce trades of the day via YouTube Shorts. And it's very nice for you to see these very short, condensed versions. However, there is a lot of work that goes on behind the scenes. I'm just cherry picking those trades or elements of the analysis that present them in a very simplistic way via the shorts. And for those not versed in our methodology, we essentially are bar volume analysts. We understand the language of the market through the bar volume relationship, and we're able to get very close to the market, as essentially we can read 90 to 95% of the bars on any given chart. So let's break down this chart and I will bring you into the finer details regarding this play. So we have a trading range: resistance, 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 support, 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 and we can draw resistance and we can draw support. And what's very important about trading ranges is that they build causality. Price bounces between a trading range. This is cause. Then as it breaks out, this is called the effect, which you will know this to be as the trend. And there's an equal relationship between the cause and effect. When you become an advanced trader of sorts, you can start to utilize the energy that is caught or made within the trading range. That tells you to hold on to the trade because of the potential effect, the energy that is built within the trading range. There is a one-to-one relationship. And this, by the way, is a key law of the universe, but also of Wyckoff, the law of cause and effect. Let's go back to the trading range. So within the trading range, first observations we have to make is we are holding higher lows. So if you just break this down into its simplest format, we have a trading range and we're holding higher lows. Now, would you think that is bullish behavior or bearish behavior? Well, of course, it's bullish behavior. If the market was showing weakness, we'll be coming down to test here. The only way the market will hold higher lows is by the presence of demand. Buyers are stepping in, unwilling to let price go down to test support. There is a bar within the trading range which I find to be of great value. Bar A. Isn't this an unusual bar? Let's talk about this bar. It pushes up, comes all the way down to close off the lows. Technically a down bar. It doesn't achieve anything, yet look at the volume. And volume is activity. Volume is all the buyers and all the sellers, and they're trying to make their stance. But what does this bar mean? It comes out of nowhere. It's sort of 3-4 times the volume. And when we see these aberrations, we have to ask yourself, what does this bar achieve? Well, it doesn't achieve anything. However, we have to note with all of this volume, technically we are still holding the higher low. Bear that in mind. Let's talk about bar 1 briefly. Now, bar 1 here, for those versed in our methodology, is known as an upthrust. We upthrust this high over here, pops its head above to reverse and close firm. Note it doesn't close back inside the trading range, but it is an upthrust off this level here, this high, and we do get a pop in volume. Naturally, one would expect the market to come down and test a little lower. However, look what happens on the next bar. Look at bar 2. We get no follow through to the downside, then we reverse to close firm on slightly lower volume, yet the bar is wider. So think about this logically. With lower volume, the market prints a wider spread. And it also disconfirms the weakness that we see on an upthrust. And for those not familiar with an upthrust, you can think of this in terms of like a liquidity grab or a stop hunt, a bullish stop hunt. However, what does bar 2 do? It eradicates any perceived weakness that one portrays. And we have to think about bar A now. Bar A, with all this volume that holds this higher low, the fact that price is now breaking above and holding above the height of the trading range, we can now perceive A as hidden buying. The market now, from the very notion that we're closing and trading above the trading range higher, we can discount any thoughts of negativity on bar A, and therefore we gain a picture of strength. Now, I know this is advanced. I've been versed in this methodology for 15, 16 years, but hopefully I'm conveying this important information in a very simplistic overview. So let me just go back so we're all on the same page. We have a trading range. We're holding higher levels of support within the trading range, which is bullish. We get an upthrust, which in itself is a sign of weakness, and with the pop in volume. However, it doesn't close in the back inside the trading range. Then boom, the very next bar, we have a failure of a sign of weakness that shows ease of movement, wider spread on lower volume. So we can buy that. This is a failure of an upthrust, and this is an advanced play. I wouldn't expect many traders around the world to actually understand this strategy. From here, we push on up, and then we see this bar over here. We get an engulfing down bar that closes off the lows, and we see some negativity. Okay, so what do we do here? Well, the market here on this bar is hinting towards lower prices. Where do you think logically the market is going to test? Well, it either tests down here, this support level, or the main support level. It doesn't mean that we should be scared out of our positions if we bought over it too. The market is allowed to come back to test newly formed support. And within the Wyckoff methodology, this is known as backup to the edge of the creek. The shortened version is BUEC. And a backup to the edge of the creek play is when you have a trading range, we break out, then we come back to test, and then we're in phase 2, which is markup. So from here, we would expect a reaction. We come back down, and we have to observe that the price action coming down, there is a little bit of flow to the downside. There are some good down bars. And we have to acknowledge that this support level doesn't hold price. It would be very nice if these two bars managed to contain price, but that doesn't happen. Then we come to the support level. And what would we expect to find at support? Buying. However, look at the buying bars. We do hold. However, the buying isn't great here. What we want to see is good demand. There is no real genuine opportunity to buy on these two bars, especially when we consider the approach. However, our second entry, or people's first entry, would be bar 3. Bar 3, what do we notice again? Similar volume as the previous bars, but the spread is twice the size. Again, which is ease of movement. With the similar volume, we print a spread which is at least twice the size. And that is demand coming into the market after these two bars have just held. But not only that, arguably you could say that we now have the best buying bar since this breakout. Now remember what I said previously in regards to trading ranges. Trading ranges build causality, and the effect is the subsequent trend. If we have all of this trading range behind us, and we've just come out and we've successfully tested, and now we're going to buy, as we see very good demand on bar 3, that also breaks this little mini downtrend here, this simple supply line, that we should have a good trade on our hands. Now we're going to take this trade a little further. as we break these highs, we can apply the trend channel, like so. So when we come up to here, we have potential target 1 where you'd want to cover, because we would expect a reaction. And don't forget, this is made in advance. When you break this high, then you can apply the parallel to this trend channel. Lo and behold, we do get a reaction. However, what do you note about this? Look at this rally. This rally is better than this rally. Arguably, it's not as long. However, look at the flow. Look how many bars it takes us to push on up into new highs. Although the market is hinting at a reaction, and we should get a reaction, we shouldn't fully cover here. We want to hold on to some of our position. As we react, we do note that volume increases a little here, but that's okay, because look at this bar. We dip down into bar 3 over here, which was kind of the change of character bar, the best buying bar we've seen since this breakout, which is a new environment. So it comes into here, it tests, we close off the lows. That's good demand. Okay, we've tested here, we found further buying. And then as we rally up above these highs, you move your stop to here, under this bar, because this is kind of like the line in the sand. If the market breaches the lows here, odds favour we're going to go back down here to test. And we don't want that. We're protecting our position here. The market finds a little bit more selling over here. It comes down. What do you note? Unable to test the lows here. Let me draw this. So that will be the support level. Then from here, this reaction is unable to test the lows. Why? Well, it's the same over here. It's bullish behavior. An additional level of support, a higher level of support. And we can take this a little bit further. As we break these highs, we can draw another trend channel where we come beautifully overbought for potential target 2, and we have to cover more. So we have a third of our position left. Note here though, look at this angle of ascent. This buying has improved. However, this kind of buying is unsustainable. The market is rising too fast too soon. And we're in an overbought condition here, nearly at a supply confluence. We're nearly overbought on this dash channel as well. When we cover from here, we have to look at the chart because we can expect a reaction. And a natural aspect of market behavior is when you're in an overbought position. When we come back inside the channel, the logical place to come back to test is the demand line. The market should unfold and find momentum and come down and test the demand line within the channel. This is the natural workings of market behavior and price that is contained within trend channels. When we become overbought, we should see some selling. We come down to the demand line. It's the same within trend channels. We come to resistance, we come to support. We become overbought, we should come down to support. This is how structure is formed within the markets. So if we're long from here and we're long from here, we potential covered, we potential covered. We notice that the angle of ascent has increased, the sustained buying the market cannot hold on to, and we're overbought. This is the natural place that I would like to put my stop, because we have to give the trade room to breathe. Could come down, test, and then rally up and produce a very aggressive kind of parabolic climactic run. On this occasion, where we can see the market does come and it does stop us out, which is completely fine. This is why it's very important that you understand the dynamics of market behavior. And this action here isn't bearish, although it is arguably the best down wave within this uptrend channel. It's the fact that the market has the right to do this. And if that makes you feel uncomfortable because you've entered over here and over here, cover or adjust your stops. And to me, this was the logical place for a third of the contracts. As I said earlier, I want to give the trade room to breathe and potentially have another climactic run. Thank you very much for listening, and I hope you do extract some value from this deeper side of analysis. The YouTube shorts are, they're a very short format and they make trading look very easy, inverted commas. However, this is the whys behind. This is the art of what we do at Acme Trades. And, we get very, very close to the market, and we're able to read the strength of the market. We're always analyzing. We're always looking. We're always trying to establish who's in control, the buyers or sellers. And we understand the market structure and how the market structure actually is the road map for price. And we can see here how important structure is within our trend channels, our higher levels of support and our resistance levels, on our higher levels of support and our trend channels, etc. Enough waffling from me. Have a great weekend. Until next time.